Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of a very common question we were asked, and that is the difference between tax avoidance and tax evasion. Since we specialize in offshore and international tax matters, we'll kind of lean it in that direction for this presentation. To begin with, tax avoidance is completely legal. If someone is doing tax planning for the purpose of reducing, minimizing, eliminating their tax, then the mere fact that they move some money offshore, for example, is not inherently criminal. There is nothing criminal about having an offshore bank account, offshore assets or investments. Tax evasion is criminal. When someone evades tax, they are knowingly and intentionally avoiding paying tax on certain income, hiding certain income, things of that nature. Unfortunately, oftentimes it just boils down to a timing issue. You know, if it's after the fact and you want to kind of go back and not dot your I's and cross your T's in an attempt to artificially reduce your tax liability, that could result in tax evasion. Tax evasion is criminal, and it can result in some pretty harsh consequences. So when it comes to tax avoidance, what are some common, simple ways to minimize tax? One way someone might do it is they can invest in a foreign property, right? You can depreciate a foreign property the same way that you could depreciate a U.S. property. The mortgage interest deduction that's available to U.S. properties are also available to foreign properties. So, you know, if you've got a significant amount of income, depending on the tax year and what rules and regulations have been promulgated or eliminated, you may be able to simply purchase some foreign properties. They have some high expenses. They've got some mortgage interest, some depreciation, commissions, possibly HOAs, etc., etc. And then if you have a renter in there and they're paying it off, that's a way to avoid an immediate tax liability on the other income you would receive if you just purchased it for cash with no mortgage. Another way to do it is just to purchase some foreign hard assets. Purchasing stock overseas, not selling it, ones that don't issue dividends, is a good way to avoid tax, as opposed to, for example, investing in high yield dividend funds and things of that nature. You know, if you're seeking to minimize your tax liability, then investing in funds that are going to produce significant amounts of dividends is probably not the best way to go about it. If you just own stock, you may have unrealized gain, but until you actually do something about it and sell it, there's no tax consequence. Another important aspect of what you may be able to do, or what you should do depending on the country, is foreign pension contributions. So, you know, if in the U.S., depending on what your employment status is, if you're self-employed, you have your own 401k, you work for an employer, you can eliminate tax on upwards of $55,000 by making pre-tax contributions to your 401k. Down the line, when you retire, you receive that money based on your current tax rate, and when you're retired, most of the time your tax rate is going to be lower than it would have been had you paid tax on that money while you were working. Well, while pension contributions into foreign retirement pensions are typically not excludable from gross income in the U.S., that's not always true. With the UK and several other countries, you can make contributions into a foreign employment-born pension plan the same way you can for a 401k, and you get the same deductions up to the limitation in the U.S. So if you were in a country that the U.S. recognized contributions as deductible, you contributed, let's say the foreign country allows $100,000. Well, you can't take $100,000 deduction from your U.S. tax return, but whatever the limit is in the U.S., you can take that. For certain countries, you have to check the treaty, because the general rule is you cannot. But by doing that, you're going to avoid an immediate tax liability. It's going to grow within the fund, hopefully, right? And then when you take the distribution, it's going to be at a lower rate. Tax evasion is a little different. If you go and you have foreign income and you don't report it on your U.S. tax return, that's evasion. As a result of not reporting that income, well, you're not paying tax on it. So you have an artificial tax reduction. That is also, that's a form of tax evasion. Another common form is, depending on the country, your U.S. status. For example, in a lot of Asian countries, if you're a non-U.S. person, they don't tax you on interest income, dividends, and capital gains. So if you go in there, maybe you're a green card holder or dual citizen, you're in Taiwan, you're in Hong Kong, you show your current permanent resident or resident status card to the banker, and they would presume that you are a foreign national, not a U.S. person. You submit a W-8 BEN instead of a W-9. They're not going to treat it as a U.S. account. They're not going to withhold any income. If you're listening and you're in this situation, you're not the only one. We work with many people who are in the same boat. So is tax avoidance a crime? Obviously not. You're not doing anything illegal, assuming that you're doing it correctly. You may make some mistakes with tax avoidance. Maybe there were some things you didn't know. Commonly misinterpreting the law when it comes to net income as a result of having a foreign property, for example, versus gross income. So if you have $11,000 of rental income, $14,000 of deductions, you're not going to have any net effective income, no tax on that, but you still have to report it. Some people think, oh, well, it's net effective zero or less than zero, so I don't have to report it because there's no income. That's not true. You have income, you just have deductions and expenses to offset it. As long as the mistakes were non-willful, you'll qualify for any one of the various programs identified below. Streamlined domestic offshore procedures, streamlined foreign offshore procedures, delinquency procedures, reasonable cause, things of that nature. If it's willful, if you were evading, you may want to consider the voluntary disclosure program. Any of those prior options are all for people who are non-willful. You absolutely do not want to submit to one of those non-willful programs if you're willful. Despite what some of these inept attorneys will tell you, it's just a minimal amount of income. The IRS will never find you. Guess what? They will, with the new FATCA regulations in place, J5, various international tax enforcement groups. They're really focusing on enforcement of foreign income account, asset, and investment compliance. So it's important that you file, dot your I's and cross your T's. We have lots of free information available on our main website, goldinglawyers.com. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.